Hey everyone, and welcome back. Today, we're diving into something that's been all over the news lately. And you know what? It's something that might seem kind of distant, like, oh, the US Fed interest rates, what does that even mean for me? But trust me, by the end of this, you'll see why this stuff actually matters a lot wherever you are in the world.
Yeah, it's one of those things, like, it's happening in the background, but it really does impact all of us.
Totally. So we got to rewind a bit first, right? Back to like 2020, 2021, that whole pandemic roller coaster. Remember those empty shelves, the crazy shipping delays, prices going haywire? The U.S. government, they stepped in big time, pumped trillions of dollars into the economy, trying to like stop things from completely falling apart.
Right, and it kind of worked. I mean, it prevented a total collapse, but like with any huge intervention, there were some side effects, let's call them, all that money sloshing around, plus businesses struggling to find workers as things reopened. It basically lit the inflation fuse, and not just in the U.S., this was global.
Yeah, suddenly everything cost more, groceries, gas, it was nuts. Exactly. And in the U.S., it peaked at 9.1% inflation in 2022. You know, you got to realize that's a 40-year high. This wasn't just economists freaking out. This was hitting people's wallets directly.
Okay, so inflation, big problem. But this is where it gets interesting to me, at least. The U.S. Fed, they've got this goal, right? They want to keep inflation around 2%. And I always thought, okay, 2%, why that number? Is that like some magic number? But it turns out it's kind of random.
Well, random might be a stretch, but it definitely has this weird origin story.
Tell me more.
So picture this. It's the late 1980s. And New Zealand.
Yeah, New Zealand.
They're battling their own inflation nightmare. And somehow, out of that, this whole let's aim for 2% inflation idea pops up.
Wait, seriously? New Zealand?
Seriously. And somehow, that little experiment there became this global thing. By 2012, even the U.S., the big kahuna of economies, they adopted the 2% target.
Wow, so that's what they've been trying to do this whole time, keep things around that 2% mark.
Exactly. And to do that, they've been yanking on that interest rate lever like crazy. Like, remember last year, all those interest rate hikes, 11 of them back to back? That's a lot. Because, see, raising interest rates, it makes borrowing more expensive. So businesses and people, they think twice before spending, which theoretically should cool things down.
Makes sense. But it's got to be tricky, right? Like, too much, and you could accidentally, like, slam the brakes on the whole economy.
Oh, absolutely. It's a total balancing act. And recently, something happened that's got everyone talking. The Fed, they hit pause on the rate hikes, and then boom, they actually cut rates.
Yeah, that got my attention. So what's the deal with that? Why cut rates now?
So the Fed, they're always watching these economic indicators, like trying to predict the future, right? And one of the things they look at is unemployment. Now, on the surface, the U.S. unemployment rate doesn't look terrible right now, but there's this thing, this signal, called the SAM rule.
The SAM rule. Okay, now you're just using fancy economist words. What's that?
Okay, so the SAM rule, it's named after this economist, Claudia Sam, and it basically says that even if the overall unemployment rate seems okay, if you see a specific kind of uptick, it can actually be like an early warning sign for a recession.
So you're saying even though things might look okay-ish right now with unemployment, this SAM rule, it's like, hold on, look closer, there might be trouble brewing.
Exactly. Like imagine a bunch of smoke, right? Even if you don't see flames yet, you know something's up. So the Fed, they see this potential smoke signal and they're thinking, okay, maybe we need to cut rates early, give the economy a little boost, try to prevent things from getting worse.
Because cheaper borrowing, that usually gets things moving again, right? People taking out loans, businesses investing, that kind of thing.
Exactly. At least that's the theory. But here's the thing. Everyone needs to understand what the U.S. does. It doesn't just stay in the U.S. It's like they're doing a cannonball in a pool. The ripples, they go everywhere.
Right. You can't have, like, the biggest economy in the world making big moves and expect it to not matter to the rest of us. So spell it out for us. How could this rate cut actually impact like people's lives in other countries?
Okay, so imagine this. You're an investor, right? And you find out you can borrow money really cheap in the US now because of this rate cut. But then in, say, I don't know, Brazil, their interest rates are way higher, which means you could potentially make more money by investing there. That's the basic idea behind what's called the carry trade.
So it's like investors see this opportunity, cheap money in the U.S., and they go looking for better returns elsewhere.
Yeah, it's like a financial game of hot potato. And we're already seeing some stock markets in other parts of the world reacting to this U.S. rate cut, probably driven by this whole carry trade thing.
Wow. Okay. So that's investment side of things. What about like regular companies? How does this affect them?
Well, think about all the businesses, especially in developing countries, who took out loans in U.S. dollars when, maybe their own currencies weren't so strong. Now, with the U.S. cutting rates, their dollar often weakens. And suddenly, those loan repayments, way cheaper.
Oh, because they're earning in their local currency, but the debt is in dollars, and now those dollars are worth less, so to speak.
Exactly. It's like, imagine owing someone $100, but then suddenly the value of the dollar drops in half. You still owe 100, but it's way easier to pay back.
Makes sense. That's wild, though, that just one decision by the Fed can have that kind of effect. What else should we be thinking about here?
Okay, so we've talked about investments, we've talked about debt, but the U.S. also plays this, crucial role as the world's financial firefighter, right?
Okay, how so?
Well, when countries get into trouble, like they're on the verge of an economic meltdown, they often turn to the U.S. for help. And one way this help happens is through things called swap lines. It's basically an agreement between central banks to exchange currencies. Like, let's say a country needs a quick influx of U.S. dollars to stabilize their financial system. The U.S. Fed can provide those dollars, like a lifeline, through a swap line with that country's central bank. And by cutting interest rates, the Fed is basically making it cheaper for countries to access those U.S. dollars through these swap lines.
Oh, so it's like the U.S. is making itself more affordable to bail out other countries if things go really south?
Got it. They're trying to prevent those dominoes from falling, because a global economic crisis, that's bad news for everyone. But, and this is important, it's not all sunshine and rainbows.
There are downsides to this, aren't there? I mean, there always are, right?
Always. And to understand them, we need to look at specific examples. Let's take the Indian IT sector. Tons of Indian tech companies, they make a good chunk of their money from U.S. clients, paid in U.S. dollars. Now, when the dollar weakens, like we've been talking about their earnings, when they convert them back to rupees, they're worth less.
So even though it might be good for paying back loans, it could hurt their bottom line overall.
Yeah, it's a trade-off. And then there's the oil factor, which, let's be real, affects everyone. When that U.S. dollar weakens, oil, which is traded in dollars, becomes more appealing to buyers using other currencies. Demand goes up, and guess what? Oil prices go up too.
And everyone feels that, right? Gas prices, grocery prices, everything goes up when oil goes up.
Yep. And for countries heavily reliant on oil imports, like, say, India, that's a big deal. They're already grappling with inflation, and this just adds fuel to the fire. So, you see, it's this interconnected web, and every decision, especially a big one like this rate cut, it sends these ripples throughout the entire global economy.
So let me get this straight. We've got this one decision, this interest rate cut happening over in the U.S., and it could end up affecting, investment strategies across the globe, the price of oil, even what I pay for groceries next week.
It's wild, right? But that's the reality. We're all connected, financially speaking, at least. And the thing is, this might not be a one-time thing. Analysts are saying, get this, up to 6x more rate cuts by 2025, trying to push those U.S. interest rates even lower.
6 more? Whoa! Okay, things are about to get even more interesting. So for folks listening, what does this all mean going forward? What should we be paying attention to as this whole thing plays out?
It's tricky, right? The Fed, they're walking a tightrope here. They want to boost the U.S. economy, get things moving, but they also don't want to set off another inflation explosion, which would be bad news globally.
Mm-hmm.
So watch closely how this impacts a few key things. 1, investment. Where's the money flowing? 2, cost of goods. Those everyday things, especially stuff affected by oil prices, that's going to be telling. And honestly, even keep an eye on global politics a bit. Countries react to these shifts, sometimes unpredictably.
It's economics 101, but then add in geopolitics, human behavior, a whole bunch of stuff we can't predict. Right.
Exactly. And it's what makes it all so fascinating, at least to me. Ha.
For sure. This has been a wild ride, honestly. I feel like I had a vague idea about this stuff before, but now I'm really seeing how those big financial headlines, they actually translate into real-world impacts for all of us. It's not just numbers on a screen.
That's the goal, right? Demystify this stuff a little, because once you get it, you start seeing those connections everywhere.
Totally. So to everyone listening, next time you see a headline about the Fed, interest rates, whatever it is, remember, it's not just financial jargon, it's a story. And you're a part of how that story unfolds. Keep asking those questions, stay informed, and we'll catch you in our next deep dive. See ya.